Hello, guys. Welcome to another exciting episode on the show, Control or Be Controlled podcast designed to help you start thinking differently and take control of your life. And I remain your host, Darlington. Today's guest is Ross Powell, an asset protection architect and the founder of Survivor 401k. For more than a decade, Ross has helped entrepreneurs, business owners, and 1099 professionals protect their wealth, reduce unnecessary taxes, and take greater control over their retirement and investment. Ross, welcome to the show.
Thank you, Darrington. It's very great to be here, Darlington. Great to be here.
All right, so I have some questions here, and I would like us to get into them. Okay, so Ross, for someone with a traditional 401k or IRA from a previous employer, what is the first smart move they should consider to take greater control of their retirement?
Well, sure. I mean, if you have an existing IRA or you have a legacy 401k, and many times many people in the United States, and this product is just for people in the United States, that you may have multiple jobs that you've changed. Maybe over the course of 10 or 15 years, you've had 3 jobs. And each of those 401ks that you had, those companies are sitting in there. You may have 10 or 20,000 or $30,000 sitting in there, each one of them separately. And individually, you really can't do much with them because of the amount. But if you were to consolidate all 3 of those, and let's say it comes to $100,000, then we can move that money into a solo 401k that we prepare for you. And then all 3 of those 401ks, and let's say another IRA that has 10,000, we can consolidate all of that into one account, which would be a business checking account at a bank that we work with, or any bank close by, really. It's a business account. We set up the 200 pages of documentation. We get your tax IDs. Again, you have to have a small business of some sort, whether it's you're a 1099 Uber driver, or you're a real estate agent, or you have a side gig that makes decent amount of money. Then you want to shield that, because a lot of times when you make your side gig will push you into, if you're a W-2 employee and you have side gig money that, let's say 10,000 that year or 20,000 that year from whatever you do, that's going to push you into another tax bracket. So you're going to get eaten up by taxes. And self-employment taxes and things like that. So what we can do then is set this 401k up, and let's call it side gig 401k PSP. We open up a bank account under that name and with tax ID. And then we tell your 401k custodians, providers, that we want to transfer your money, let's say John Doe, his money from this particular, let's say from Fidelity, transfer their money to side gig 401k PSP. We tell Vanguard the same thing, and the other one may be at East Street or something. And then you have your IRA at a bank. We tell all of those providers to send their money directly to, and it's a non-taxable event. It's a direct rollover transfer, and you're not going to have any tax consequences. So instead of having 4 different products, all of them not having enough money to do anything with, to having one product that has $110,000 in it. And with that $110,000, you can invest in real estate, you can invest in precious metals, private equity, private loans, tax liens, anything that you can create in your mind, whatever your creativity is. There's a lot of things you can do, especially in the areas that you know best about. So real estate agents, they know about real estate. You may have a person that's a that's a solopreneur. You may be an electrician or plumber out on his own by himself. You may have, a local tenant's doctor, again, who gets paid 1099 at a hospital. So there's a lot of things you can do, and then so any of the side gig income or your primary income, you can contribute up to $72,000 a year under 50. And if you're over 50, that's $80,000. And then if you're in I think it's 63 to 65 range, somewhere around in 63, 64, it's a special program. Now the IRS says that you put you up to 83,000 and some change, 83.5, I think. So you have ability to shield a lot of money from taxes now, and then when you need to take it out later, you'll pay the taxes then. But in the interim, if you want to convert that to Roth dollars, and after 5 years, you don't pay any taxes on that money whatsoever. So there's a lot of great benefits. And the other thing that's great about consolidating all of these 401ks is the fact that you now have 110,000. You can borrow 50% of that, or up to $50,000. And this $50,000 is basically a line of credit or a loan. So if you need to buy a new car, you stroke a check, you stroke a check for whatever the amount, put it in your personal account. Then you start making payments back to yourself. And the interest rates are pretty good. It's about probably right now with the way the interest rates are, and they're probably going to cut, they're not going to go up. I don't think the Fed's going to make them go up. So I would suggest that, you're probably in the 6.5, 7 range, which is cheap money for a new car or a used car. So you just stroke a check from your checkbook to the dealership and you're golden, and you pay yourself back the loan. There's no credit check. There's no qualifying. You just stroke the check and be done with it. So it's a great opportunity, especially for real estate agents. If they see a deal, they can use that money for actually in the loan side, they can use that money for a down payment or earnest money right there on the spot if they know a deal that nobody knows, or fix and flips. Those kind of things are a great opportunity for our clients, and many of them done it.
Right, thank you so much, Ross. That was a very, very wonderful answer. So, moving on, my next question for you is this. We often talk about gaining checkbook control. What does that actually mean, and why is it so important?
Sure, that's one of the key benefits of this program. So like I mentioned about the loan, so let's say that you say, let's just carry this story on. So side gig 401k, you are Joe Doe, and your side gig 401k PSP, and you have 110,000 in your account, and you want to invest in something, whether it's precious metals or a piece of, let's say that you find 2 acres of land for $30,000 wherever you're living, and you that's in a fast growing area. So you have two choices. You can have your 401k invest in it directly. So you go and you find the owner or whoever, if there's an agent, and especially real estate agents, if you'll come across these deals and you say, this is an area that we know it's growing in the next 5 years, I'm going to double or triple my money just sitting on the land. Then your 401k, so you go up to the owner and say, all right, he wants 30,000. Okay, done. You give him the earnest money and a down payment. And then you go and close and you transfer the money from your 401k directly. So there's no custodian request. There's no approvals with an IRA 401ks in your old marketplaces can't do this anyway. You're locked into the stock market and you can't do anything outside of that. But with the IRA, if it's in a traditional bank and it's not self-directed, then you're going to be locked into the Wall Street as well. So these opportunities would never come up for you. So at the end of the day, this gives you direct checkbook control. So you can either write a check right there with the owner, straight out of your business checking account, which you control, or if you're, depending on the bank that we suggest, Fortis Bank out of Colorado and Titan Bank out of Dallas, you can wire directly from your desktop the money. So you control the money. You can send it directly to the owner for your earnest money, or you can, at the close, you can send the money to the titling company. And then suddenly now your 401k owns this 2 acres of land. And let's say 3 years from now, that $30,000 that you spend is now worth $100,000 because the city has grown out that direction. I mean, I'm living in South Texas and we're seeing it every day. There's no way to go north of San Antonio. So everybody has to move south, which means that there's really no room in the north, or it's so expensive nobody can pay for it. So everybody's moving to the south of San Antonio, which is making the property values go up, especially raw land. A lot of development, a lot of companies. Toyota's expanding in San Antonio to the south. So if you own that land, you're going to make a lot of money. So that's where the benefit of this checkbook control is. It's literally you have debit card, ACH, wire, and check writing capability, and you make the decision. Where if you were married, you and your spouse make the decision. So you don't have to go through a custodian and wait 3 weeks to get your check as you're the money wired. You do it right there by yourself. So the buck stops with you because you are the plan administrator, you are the trustee, and you are the fiduciary, meaning that you are the one that makes the investments decisions. So that is a great way to control your retirement. And if you want to be in Wall Street, you can open up a brokerage account at E-Trade or Fidelity or whatever under that and trade stocks with your money as well. So you can have Main Street as well as Wall Street, the best of both worlds, and flexibility to do that. And if you make a great deal on a stock and it goes way up, you can move those profits out back into your bank account and then divert those monies back into real estate or gold or whatever you want to buy, or even CDs for that one. You can put your money in CDs if you want to. So again, it just depends on or money market accounts. It always depends on what your level of risk tolerance is.
Okay, Ross, thank you for that wonderful explanation. So, tell us the difference between a standard self-directed retirement account and the structures you help clients to build.
Would you ask the question again? I couldn't hear you.
Tell us the difference between a standard self-directed retirement account and the structures that you help clients build.
Well, I mean, there's self-directed IRAs, which are a lot of people use, and checkbook IRAs, which is an IRA with an LLC. And you have limits on the standard IRA, whether self-directed or directed in a bank or in a brokerage house. Your limits are much less. So the most recent IRA, I believe it's 8,000 and maybe 8,200, whereas the 401k contribution rate is 72,000. And with the self-directed IRA, you still have a custodian between you and your goal, and so you have to submit your deal to the IRA owner or the IRA custodian, and they may or may not allow you to do it. It all depends on how they're set up and what their compliance people allow you to do. Whereas a 401k is the buck stops with you, and you have everything. You can do pretty much whatever you want, with the exception there are some major rails that you have to be aware of, or ditches on either side, which we call prohibitive transactions. And many of these deal or part with the IRA as well, but because you can't deal with your family, meaning you can't deal with your ascendants, meaning your parents, your grandparents, your great-grandparents, and you cannot deal with your children, your grandchildren, your in-laws, your outlaws. You can't deal with any of those. Meaning that if you wanted to buy a house, let's say your child is going to college or trade school, which I would recommend, but to trade school or college, and you want to buy a house there so they can rent, instead of paying somebody else rent, you can pay yourself rent. But your child cannot live in that because they're a descendant of you. However, your nieces, nephews, cousins, aunts, uncles, anybody in the lateral of your family tree can do it, just not your descendants or ascendants. So that's a major one, and you can't deal with it yourself. So you can't buy, say, a property in Cabo, Mexico, and go spend half the year there in it. That's a prohibitive transaction, will get you in trouble with the IRS, and they'll invalidate your entire plan, and then from there they will tax you to death for it. So you'll have to take a full distribution and pay tax as income that year, and you're going to just get beat to death with taxes, and you wish you had never done it. So that's why when we have our clients are making any deal at the beginning of their plan, that they call me and run their deals through me to make sure that there aren't any landmines they're going to step on during that process. So that's part of our service, our white glove service. We actually help our clients navigate the legalities of what they can do And if we don't know, we have attorneys that can answer the questions for them. We also have accountants so we can send people to help them navigate that piece of it as well. So, and another difference is paperwork wise, an IRA has to submit a 5,500 each year, or 5498, depending on how they roll it over. Whereas the 401k, unless you have over $250,000, you don't have to submit anything to the government. You just have to keep good records at your house, keep a ledger, a spreadsheet, and we have spreadsheets we can send people to help them track their investments. So that it actually is a major benefit to it. Now, if you don't have any self-employment income, which is not a lot, you just a few $100s, about that less than $1,000, you will qualify you for it. And it doesn't have, so that's the major difference. In IRA, you don't have to have income, but you're hit with, lower amounts that you can set aside. And if you have a small business, you can, even doing multi-level marketing, or you're working at a farm, you're selling stuff at a farmer's market, anybody can have a small business. The idea from the IRS is to have the intent of making a profit. So that's a wide open scope. So generally speaking, everybody can attain that if they put their mind to it. And I would encourage everybody it's a W-2 employer in the current environment to start looking at a side gig to fall back on in the event that you get laid off or you get fired, that you still have some income coming in. And then if that's a passion you have, you can kickstart it and really get it going. So again, that's the benefit of the 401k over the IRAs.
Okay, thank you so much, Ross. So, with economics uncertainty and inflation and changing tax laws, what should entrepreneurs be doing today to better protect their financial future?
With the changing tax laws, I mean, the 401k has been around since 2002, going on 24 years now. And only 2 or 3% of the population knows anything about it. And our tax laws we have the Secure Act 2.0 or some changes, and the 401k gets updated, every 6 years or so, or there's less legislation came through. Like during COVID, there was 4 major changes in the tax law for 401ks. And so we updated people's documents and sent them updates and keep them compliant with the IRS. So this product, again, has been around, is very stable. It's very popular. In fact, I know there's a lot of movement to try to get people to be more involved in it. But our financial system from investment is controlled by financial advisors, and which I'm not I'm right on the top. I'm not a certified financial planner. I don't have license to deal with Wall Street. I can't be your fiduciary. I can only set up your plans and tell you what you can't do. So I don't make decisions for you. But if the IRA laws and the others are all pretty stable right now. I know that President Trump and Congress is talking about, through the Secure Act 2.0 and maybe 2.1 or whatever they're going to call it, is trying to expand retirement. And now they're creating accounts for young people that you can fund money with and even put stock in, the Trump accounts. So there's a lot of move for people to have retirement, because a lot of folks end at the end of the road and they don't have anything saved. So it's a very, very important aspect of your life to save for your retirement if you can. And then, that's the key thing. The rules are pretty straightforward. And so in the solo 401k, you can do very well and not make a mistake. It's kind of a double-edged sword. It's easy to make a mistake, but it's difficult to make a mistake at the same time. If you know what you're doing and you ask questions, you shouldn't make a mistake and get cost penalties or anything. So our job is to keep people out of hot water is our goal.
All right, Ross. So here is my final question for you. If there's one thing you wish listeners can take away from this entire conversation, what would you want that to be?
if there is, say the question again. I'm sorry, Darlington. I didn't understand the question.
If there's one thing, just one message that you wish listeners will take away from this conversation, what would you want that to be?
Oh, to take control of your life and your retirement. That's the key thing. You don't want to rely on everybody else to do it for you. So if you don't understand it, then you're going to get a surprise. So the big thing here is, and takeaway, get a side gig no matter who you are. Start a side business just to have, again, you can make it a hobby. And then when you start making enough money, you can do a 401k. But always have a plan B in your life. And the solo 401k is a great plan B for people. And if you're an entrepreneur, a real estate agent, a locum tenens doctor, any independent electrician, plumber, whoever you are, if you're not saving for the money and you're paying taxes on money that you could divert into a retirement plan, that's the key thing. So it's the key message is it's not how much you make, it's how much you keep. Because you can make a lot of money but pay a lot of taxes and you're not keeping that money. That money is going to the government. And especially if you're self-employed, there's a way to avoid the 15.7 unemployment tax or the self-employment tax. So there's a way that you can avoid that by how we can structure LLCs and things. But the bottom line is you need to take control of your life and your retirement. And the solo 401k is the best way to do it, in my opinion.
All right, Ross, thank you so much. Thank you for joining us today and sharing your insights on wealth building, asset protection, and financial independence. So for those that would like to learn more about your work, surviving 401k, and what you do, Ross, how can they connect with you?
Sure. If you want to find out more, you can go to one of our pages that's called watch.survival401k.com to learn more, where I go into more detail than I have today. And then, or if you want to make a contact with us and set up an appointment, you can go to survival401k.com and click on the contact button, or you can call me at 210-639-7227 to talk to me directly. So if I don't pick up, you can just leave me a message. We'd be glad to talk to you. But the best way to do it is to set up an appointment on our contact page of survival401k.com. And we can set up an appointment for a free 30-minute consultation. And if I can help you, I will. If I can't, I'll tell you somebody who can, or the best of that I can. So I don't want you being left out there on an ice float. We want to help you.
All right, once again, thank you so much. And thanks to all my listeners. You guys are the reason why we always do this. If you enjoyed this episode, please subscribe, leave us a review, and share it with someone who could benefit from today's conversation. So until next time, I will see you guys again. Take control of your life, or your life will control you. Thank you so much, Ross, for coming to our show.
Thank you for having me.